Hi guys, welcome to a new video here at Sublime Traders. I am Logical Orange, and in this video we are going to take a look at the top 10 most important chart patterns that you should know as a new trader. Let's go to the charts.
We gon' make sure you never miss a trade again. Watch how you get paid over and over again. Account management.
So a chart pattern is a shape within a price chart that can help us suggest where the price might go next, and it's based on what it has done in the past. Okay, so chart patterns are the basis of technical analysis. Basically everyone has used them for a lot of years now, decades even, and if you know what you are looking at, you can get a pretty decent idea or a confirmation based on your other indicators that can really tell you where the price might go. So let's start. So the first and the most obvious chart pattern would be the head and shoulders pattern, which is a chart pattern with a large peak and two smaller peaks, and it basically looks like a head and shoulders. So it has a neckline that we can see right here. This is the formation I am talking about. This is a head and shoulders pattern. It has a neckline and two shoulders. This is the left shoulder, this is the right shoulder, and this is the head. Typically, the first and the third peak will be smaller than the second, which is obvious, and but we'll all fall back to the same support. So the same support is the neckline. This is the line that I have just traced right here, and once the third peak has fallen back to the level of support, it is likely that it will break out into a bearish downtrend, as it has done here. So we have a support line, left shoulder, head, right shoulder, break through the support, going bearish. Another very important pattern is the double top, which is another pattern that traders use to highlight trend reversals. And typically an asset's price will experience a peak, the first peak. It will then retrace, and then it will get to another peak, which is almost at the same level as the first one, and then it will go back to support. As the head and shoulders pattern, it also has a neckline, and it also is an indicator of a bearish trend if the support line is broken. Next up, the double bottom, which is basically a double top inversed, of course. It also has a neckline. I will draw the neckline right here. This is a neckline, and it basically just hits bottom, retraces to a resistance, hits the same bottom again, and then on the second retest of the resistance, it breaks. This is a clear signal of a double bottom and trend reversal. Next up, we have the rounding bottom chart pattern that can signify a continuation or a reversal. For instance, during an uptrend or of an asset's price, it may fall back slightly before rising once more, and this would be like a bullish continuation. You can see it in this shape, and in my experience this is a reversal pattern, and also helps identify bottoms. We might say they are part of the same family, but the next pattern is the cup and handle pattern, and it is very similar to a rounding bottom, but has another element to it. It is a falling handle that we can find right here, and this pattern is indicative of trend reversal. It can be a cup and handle, or it can be an inverse cup and handle. So a cup and handle usually leads to upside, further upside, and an inverse cup and handle usually leads to further downside. It is very potent. It is a very potent pattern, and it is highly effective in high time frames, so 4 hours and more. A very common but a very important chart pattern to know about is the wedge. Wedges have multiple orientations. There can be downwards pointing wedges, there can be upwards pointing wedges. Basically, it is the price action which is caught between the support and the resistance trend lines, and it will eventually try to escape. As a general rule, please remember one thing with wedges: the line that has a bigger angle usually is the line that will be broken. So in the first example, I have a resistance line that has a higher angle than the support line. It is broken. In the upwards pointing wedge, I have a support line that has a slightly higher angle than the resistance line, and it is broken. These examples you can find on basically every chart. It is a very common chart pattern, and it usually breaks as I have told you. Next up, we have the pennant or the flag formation, which usually happens after the price action has seen an increase and then a consolidation period. Of course, this formation can be bearish also if the price action goes the other way. Usually, when the price action reaches the end of the pennant, it will just break on one side and the other, and in this case we should enter our trades when the pattern is broken. Note there is a small difference between the pennant and the wedge, because the pennant is always horizontal while the wedge is always upwards or downwards pointing. So next up we have the ascending triangle pattern, and this is a bullish continuation pattern, and ascending triangles can be drawn onto charts by just placing a horizontal line along the swing highs and then drawing the ascending trend line along the swing lows. So ascending triangles often have two or more identical peak highs, which will allow them to have a horizontal resistance line drawn, and the overall uptrend is bullish. Similarly, we have the descending triangle, which of course has the support line straight because it has several reversal points that are at about the same level, and it has lower highs. Note that you don't really need to be precise, like to millimeter precise for the bottom or the highs. This is just a chart pattern, and it indicates the overall trend. As you see, it has broken bearish here. So the descending triangle is a bearish pattern. So lastly, we have the symmetrical triangle, and this is a pattern that can be either bullish or bearish depending on the market, but in either case it is normally a continuation pattern. So this means that the market will usually continue in the same direction that it was pointing in before. However, in my experience, this pattern has a 50-50 chance of getting out on either side and even reversing, like in this example. So chart patterns are just a form of technical analysis. It should always be used with other technical indicators, oscillators, any kind of other indicator, and it should be part of your technical analysis checklist before starting a trade. So this is a very important aspect of trading. Learning to read charts is very important. In the next video we are going to talk about candle patterns, which is a different thing. For examples like 3 white soldiers or engulfing candles. This is also something you should know about. This is all for today. Thank you for watching. This is Logical Orange, and if you want to know more about us, please join our Telegram channel, like and subscribe if you liked our videos, and see you on the next one. Thank you and happy trading.